This is Business Weekend with Ross Greenwood.
Hi and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company. Coming up on the program today, how will Australia cope with the fastest increase in interest rates in almost 30 years? The answer lies with future wages claims and those protests over pay that are now hitting the streets. But the Reserve Bank, responsible for the rate rises, is not above reproach. In fact, Australia's most experienced market economist, Westpac's Bill Evans, says, in hindsight, printing money during the pandemic was the worst thing the RBA could have done.
And the sensitivity of Australian households to the Reserve Bank cash rate is extraordinarily high.
But as we move from the pandemic lockdowns to new inflation and interest rate worries, something's been left behind, and that's all that stock that was bought by retailers but never sold. It's called the bullwhip effect, and the man who tipped the global financial crisis now says the bullwhip could trigger the next economic downturn.
Retailers will scramble to order more and in some cases over-order, and further up the value chain, the manufacturers also tend to overorder.
So all of that and plenty more coming up on today's program. But look, let's start with the economy and interest rates and the narrow path that central banks, including our own Reserve Bank, are now navigating to avoid a plunge into recession or an economic downturn. Until this week, it was 12 years since the Reserve Bank raised rates in 3 consecutive months. But more increases are on the way, and eventually they will hurt. But the cure for these cost increases, higher wages, might also be the curse if they get out of control. As people take to the streets demanding higher wages, it's a reflection that large parts of the community think that times are getting tougher, that their costs are rising too fast, their wages too slow.
You know, we do know, we do understand, we do appreciate that the skyrocketing costs of essentials like groceries and petrol and electricity and other essentials as well is putting extreme pressure on on household budgets, and that this interest rate rise today will add to the pain.
There's just one thing on evidence right now. The rate rises have not yet hit Australian spending. Retail sales have been at record levels for the past 5 months. Job advertisements show there are more vacancies available than there are unemployed people to fill them. It's boom time stuff. But eventually, something has to give.
And that's basically what the Reserve Bank is trying to do, to tiptoe along the path to bring the spending down without terrifying families too much about what happens next.
As the Reserve Bank tiptoes, it's also hoping inflation disappears as quickly as it arrived. After all, if oil prices jump from $100 to $120 a barrel, that's 20% inflation. But if the following year oil stays at $120 a barrel, that's zero inflation. On oil, this week, there was a clue inflation will ease as prices fell below $100 US a barrel amid worries about a global recession.
You know, we're still in the midst of other issues with, say, gas and electricity. But certainly when it comes to the oil market, which is globally driven, there is certainly a case that we may see prices fall for the remainder of 2022.
All this has caused bond market interest rates to ease here and around the world in recent weeks. That's an anticipation that if there is a recession or economic downturn, central banks might have to do another U-turn and start cutting rates, maybe by as early as late next year.
They could, however, go too hard. And you could see even those marvellous retail numbers we had underscored today start to weaken. You could see the even more marvellous unemployment rate, essentially the lowest in half a century, start to go up again. And walking that path between going too hard and causing a slowdown or even a recession, and not going hard enough and having to continue, if you like, to keep an interest rate squeeze on for longer. That stagflation scenario, they're trying to aim between the two.
For while oil prices and energy shocks might have started this inflation outbreak, the bigger problem is wages inflation. It's harder for the Reserve Bank and other central banks to squeeze out of their economies.
The Reserve Bank's tasked with trying to keep it under control. There's only so much they can do about floods, about wars in the Ukraine, but they do have to make sure that the underlying economy is not overheating, and that's best represented by our unemployment rate and, of course, what you just mentioned, the wage threat. And we're seeing industrial action become more broad-based, more common, wage claims going up. This is the big inflation risk for Australia now, is wages and inflation getting entrenched.
It's going relatively hard, relatively fast, because it gets scared that inflation starts to get cemented in place, that wages start to follow, prices start to follow wages. And that circularity is a real risk.
And apart from money markets, banks are already signalling where they think interest rates are headed. 2- and 3-year fixed-rate mortgages that were around 2% at the start of this year are now between 5 and 6.5%.
I think that they have finally peaked, or at least near the peak, we would hope. They could start coming back down, hopefully. In fact, the cash rate, forecast to believe, yes, it might hit 2.5, 2.6% by February next year, but we also could see a correction by the RBA.
But any forecasts about interest rates should be viewed with wages at the back of your mind. If the protests in the streets and wage claims to come are any indication, higher inflation and interest rates could be more sticky than many find comfortable, including the Reserve Bank Board. So let's bring into this conversation Australia's most experienced economist, Westpac's chief economist, Bill Evans. He was appointed in 1991 when Australia's last great recession was raging. In his time, he's seen 4 Reserve Bank governors, Bernie Fraser, Ian Macfarlane, Glenn Stevens and now Philip Lowe. So he is almost the perfect person to gain a perspective about the performance of the Reserve Bank, plus the differences and similarities between now and the lead up to that early 1990s recession.
Well, I think the number one parallel was that the shock to inflation came from a commodity, the oil shock this time. This time it's been oil and gas and food, but it's been a similar issue. And the issue in the 70s was that that shock fed into inflation, inflationary expectations took off, and it started to feed into wages, and we had that terrible situation of so-called indexation, where whatever happened to prices went straight into wages. Businesses felt they had very strong pricing power, and it got embedded in the system for such a long time, and most people were thinking more about inflation, more about what they were getting paid relative to someone else. And it was what I would call the lost decade. And Australia, of course, took another 10 years through the 80s as well to get out of it, whereas the US, through the courtesy of Paul Volcker, went to 20% rates and squeezed the inflation out in the early 80s. But of course, we went for another 10 years and we had that recession you referred to in the late 80s, early 90s, when finally inflation was squeezed out of the system. Very painful.
OK, but that was called by Paul Keating the recession we had to have. Today, are we likely to have a recession, or is it a recession that we have to have?
Look, I think it'll depend upon the resilience of inflation. And when I look at our forecasts, we are expecting that next year inflation will trend down to the sort of low 3s by the end of the year, coming from the 5.1 it is, and likely to print 5.9 when we get the next index. And that'll be because we're expecting oil prices to come back. We're expecting building materials costs to come back, particularly with the US construction cycle slowing down. And one of the big factors in building materials is that we used to import a lot from the US, and that was getting harder to get. And of course, we have to assume some sort of resolution over the longer term to the war in Europe that could take some pressure off food. So all of those big supply shocks we're expecting to ease. So over next year, certainly wages growth will be stronger, and we're looking for about 4% wages growth, but inflation to come back to 3%. And so this issue about we've got to get positive real wages growth, I think workers will get that next year. And of course, because we don't have such a centralised system as we had in the 70s, only about 2.7 million workers are on the minimum wage or on the modern award system out of about 10.7, whereas 4 million are on individual agreements and 4 on enterprise bargaining. So it's nowhere near as centralised. So I think we've got a good chance of avoiding that wage price spiral, which was the big problem for Australia in the 70s.
OK, so then take me to the level of household debt. and also the level of government debt? Because when you add all of those together, Australia is clearly a very heavily indebted nation. Is it capable of withstanding the interest rate rises that are required to squeeze the inflation out of our system?
I don't see the government debt being a major issue. Most of the projections suggest that gross debt will stabilise around 45% of GDP. In the US and the UK, of course, debt is 100% of GDP. So I don't think our problem relative to the rest of the world is in government debt, but certainly in household debt we're world class. And the sensitivity of Australian households to the Reserve Bank cash rate is extraordinarily high. If you take the US, those mortgages are 30-year fixed or up to 30-year fixed. So when the Fed raises rates and pushes up bond rates, you only affect new borrowers, whereas in Australia, 60% of borrowing of mortgages are floating rate, and of the 40%, 75% of those will be maturing by the end of 2023. So you can effectively say that 90% of household borrowers are exposed to the Reserve Bank cash rate, and as you point out, the level of debt has just exploded. So when I look at the comparison between when the Reserve Bank was last raising rates in 2009-10, when they went from 3% to 4.75%, I would say that that 4.75% is now equivalent to around 2%.
Okay, so that being the case, does that put a cap on how high the Reserve Bank can raise interest rates without potentially damaging households, therefore damaging spending and therefore damaging the economy?
Well, I think from the Reserve Bank's perspective, they have to get that balance right. Their number one objective has to be to contain the inflation pressures. Now, we understand that most of those pressures are coming from the supply side, but there are also an issue. You get inflation when there's an imbalance between supply and demand. So demand is much higher than supply. Now, okay, so supply is low, but if you have to bring down demand in order to try and close that gap, that means higher interest rates. So they will have to do that, but the effectiveness of their rate hikes will be quite substantial. And what I am expecting them to do, I'm expecting them to go 50 basis points in August, once they get confronted by another really large inflation print. But that'll only have rates at 1.85, and I think the so-called neutral level is between 1.5 and 2. Now, that's a lot lower than it's been in the past, for the very point you made about having such high levels of debt. And I think there's a very strong case to say once you're in the upper end of that neutral range, time to pause for a couple of months to assess exactly some of those factors that you're talking about.
When you first became the chief economist at Westpac, there was Bernie Fraser as the governor of the Reserve Bank, then Ian Macfarlane, then it was Glenn Stevens, now Philip Lowe. Hindsight being hindsight, there's almost been a beyond reproach sort of view of the Reserve Bank that they can never be wrong. Can the Reserve Bank in Australia be wrong in its settings? Can it be wrong in its communication to the markets?
Well, Ian Macfarlane and Glenn Stevens had some difficult challenges, but also had they were never confronted with a sort of the government spending $320 billion in a year to protect the economy against COVID. So over those two 10-year periods, both of them averaged inflation very close to the 2.5%. So from that perspective, they achieved their objective. Of course, Phil Lowe was for the first between 2016, when he was first appointed, up until 2019, inflation was well below the 2% range. So he's below that. Now, of course, he's well above it. So he's had a much tougher challenge. And, of course, he has been criticised for a number of the policies that were adopted during that incredibly difficult COVID period. And I think people have, in hindsight, we shouldn't forget how desperate we were back in that March period where the government was talking about 20% unemployment rate. The economy was under a great deal of stress. The government spent so much money to insulate the economy from that, and the Reserve Bank decided to introduce not only very low interest rates, but also some unconventional policies, and that's where they've been criticised.
Okay, so hindsight being hindsight, is that criticism justified? Do you think was the communication, was the messaging from the Reserve Bank wrong at any point along this step? Was it too late to actually recognise the inflation that was coming down the track?
Well, I think one of the big issues was the so-called yield curve control policy, where the Reserve Bank said we'll buy 3-year bonds at the cash rate. In other words, we don't think the cash rate will be rising over that 3-year period. Now, that policy has been heavily criticised, but that had a tremendously stimulatory effect on the economy during that period. And what people don't realise is the Reserve Bank avoided quantitative easing, bond buying, in March and didn't take it up until November. I think that quantitative easing policy, printing money that all central banks around the world did, has been a major damaging policy at a time when governments were providing the support. The government was there to support incomes. I don't think it was the role of the central banks in that period to print money, which of course has ended up mainly showing up in asset prices. And now we're going to have to deal with the downturn in the asset prices as rates have to rise. So in many ways, the Reserve Bank, in delaying the introduction of quantitative easing, actually did quite a sensible thing.
OK, but that being the case, it still did quantitative easing. And though many say, well, the inflation we see now is coming from overseas, it's oil prices, it's supply chains, all that type of thing, the reality is that the Reserve Bank bought back $350 billion worth of bonds, which clearly is printing money, which is adding to the inflationary story today, which it's having to deal with.
Well, they held out against it. In March, when everyone was saying you've got to throw everything at it, they threw a different policy at it that I think was a lot more effective. And then, of course, by November, all of the other central banks were doing it. They felt that it was putting upward pressure on the Aussie dollar, and they felt that they had to go along with what other central banks were doing. So I actually felt that their initial policies in March showed a high degree of courage and independence rather than just following what everybody else was doing. Eventually they fell into line with that, and of course, as you say, they've got $280 billion that came through the bond buying program. They've got another $36 billion that came through the yield curve control program, and then another $44 billion that was there to settle the bond market down. So they do have, as you say, a very large bond portfolio at the moment. And of course, if you compare the rates at which they bought the bonds compared to where market rates are now, there have been some major losses.
I'll tell you what, Bill, it's always good to have a chat to you, and I appreciate your time today.
Thanks, Ross.
Bill Evans there. Coming up after the break, how Australia built the world's leading carbon offsets market, now valued at $2 billion, but then forgot to invest in it. Plus the bullwhip effect, how retailers are now suffering from stuffed warehouses after the pandemic lockdowns. Thanks for being with us here on Business Weekend. This week's New South Wales floods are, for some, the 4th time water has come through their homes or businesses in the past 18 months. Yet some try to call them 1 in 100-year floods. Yet 6 years ago, Infrastructure Australia placed the Hawkesbury Nepean Valley flood management on its highest priority list and advocated flood mitigation, including raising the wall of the giant Warragamba Dam. Remember, it was originally created to provide Sydney's drinking water, but nothing happened. Now, with so many living in potential flood zones, how can future harm be prevented? Sam Kernahan is the Resilience Director for the Committee for Sydney and has led the implementation of climate and disaster resilience programs with the Rockefeller Foundation's 100 Resilient Cities and also with the Asian Development Bank. He joins me now. Sam, many thanks for your time. I want to start with this about no city is ever completely safe. I guess that's the reality of it. But 4 floods coming through businesses and properties in 18 months, that almost looks like neglect.
You're right, Ross. No city is resilient to the uncertainty of future events, but also the things that we know about. And I guess part of you talked about the 100 Resilient Cities work that I've been involved in, but also the work of the Committee for Sydney is focused on really trying to identify what those hazard risks are and some of the options that cities have, like Sydney, to work their way out of the risks we know about, but also what might happen in the future.
But this is a risk we do know about, and I've got here in front of me Infrastructure Australia, the priority initiatives. There is an increasing flood risk in the highly populated and major growth region of the Hawkesbury Nepean Valley. Over the long term, the average annual cost of flood damage in the Hawkesbury Nepean Valley is expected to be in the order of $70 million per year. Now, I would suggest that was basically 2016. That $70 million is at least 10 or maybe many times that. The reality is that not much has been done.
So the Hawkesbury Nepean floodplain is one of our, as you said, one of the most highly at-risk parts of Australia, and in the future is expected to become one of the most uninsurable. So it's really important that we do take steps to reduce that risk. The Warragamba Dam is one investment that's been talked about, but we need to be clear that it's not a silver bullet on its own. It will improve the amount of time people have to evacuate from the floodplain, which is really important. But it's not going to remove flood risk. And so we need to be careful that if we do make the decision to build the dam, that we are also doing other things like improving flood evacuation infrastructure so people can get out. That we're looking at the amount of removing people from still the most at-risk parts of the city, by investing in buybacks. But the main thing we need to do is actually look at what is the density of development we want to have in these areas that are at risk. And in the Hawkesbury Nepean floodplain, we need to look at a long-term plan to actually reduce development in these areas.
So I'm going to go back to you on that and say, well, okay, I totally get that. There's an argument here for housing buybacks. Let's start there. Now, the problem is, A, the expense of many of those homes and the number of homes that have been built. Now, I'm not just saying there. You can think about Lismore in northern New South Wales. You can think of parts of southeast Queensland. There are no doubt parts of Victoria as well. And there have been buybacks in all of these places. The problem is you can't buy enough houses back quickly enough, and nor do you have the budget to do so. So it doesn't make you terribly resilient.
Buybacks have been successful, as you say, in some parts of Brisbane, for instance. They had voluntary buybacks after the 2011 floods in Grantham, and that's been successful in reducing flood risk in that part of Brisbane. Internationally, so going to places like Christchurch, they used compulsory buybacks after the earthquake to remove development from areas that they've identified as being places they never want people to live again. It's just too dangerous. Here in Sydney, there needs to be a pathway out for people who are consistently put at risk, a safety net, if you like, for those people who, as you've said, have been flooded out in the last 4 times in the last 18 months. They continually need to evacuate, and then they need to go back and rebuild their lives, rebuild their homes. They may not be able to afford insurance, so they may not have insurance, because we know parts of the Hawkesbury Nepean have insurance costs of $30,000 per person. So it's not affordable, if you like, for those people to live in those places anyway. OK,
so then you go, OK, so there's that area of Sydney, because one of the issues is that as Australia grows its population, and Australia has aspirations to raise its population significantly, the people have got to live somewhere. Yeah. And these areas have been some of the open spaces where the people can go, notwithstanding the potential risk that they are facing by actually putting housing there. Councils, state governments, they've collected the stamp duty, they've collected the taxes, yet the housing still goes there with the risk.
So you're exactly right. One of the things I think we need to do better is disclose and share the risk that people are buying into. Because it's not the property owner who's, if you like, made the mistake. They've bought a house or are buying into a house that has been approved by policymakers, by local government, if you like. And so there's a need for us to be sharing the risk that people are buying into, not just where they live below the 1 in 100, that's the flood planning level, but actually anywhere on that floodplain. And actually, and make sure that they're aware not just of that flood risk, but also the risk of not being able to evacuate. OK,
so then you go to a place like Roma, where levee banks were built. That's classic mitigation, I kind of guess, which allows the insurance costs in that community to come down. You've got places like Lismore. Well, again, you've got to find either mitigation, because otherwise you've got a town that may turn into a ghost town because the banks don't want to actually lend there because they're worried about the security, and the insurance companies don't want to insure there, which means really it's difficult for that community opportunity to survive unless they can get those very basics that they need.
You're right. And unfortunately, the Hawkesbury Nepean floodplain doesn't have a simple answer in that the floodplain has 4 catchments and the Warragamba Dam only reduces runoff from 1 catchment. So even if we build the dam, there are 3 other catchments that if we had major storms in those areas, you would still get major flooding. So it's, as I said, it's not the silver bullet, and we need to look at, what those mitigation options are. The Insurance Council of Australia is now not supporting the building of the Warragamba Dam, and I think partly that's because it's not going to have the same impact as you've talked about in Roma.
So, all right. So does that mean, as Australia seeks greater population, that we have to identify the areas that do least harm in the future?
We're very conscious of that in trying to build more resilient cities and places for people to live, but we can also learn from the past. And we're not talking about the far distant past, we're talking about March last year and June last year and March this year. This is information about the flood risk that we can use and learn from and implement.
Many thanks for your time here on the program today.
Thanks very much.
Yeah, it's an interesting one, that one, there's no doubt. Well, sometimes when you are trying to work out which way the economy will head in future, you have to look at what's happening right in front of you. Like, how many of you noticed and thought about how deeply discounted the mid-year sales were just over the past few weeks? Or indeed the implication for retailers if they can't clear bloated stock levels? Well, the man who predicted the global financial crisis has been watching and thinking about something called the bullwhip effect, as Edward Boyd reports.
Michael Burry, the millionaire hedge fund manager who predicted the US housing crash in 2008, triggering the global financial crisis, is back with another warning: the bullwhip effect. He has encouraged people to investigate it and says it could spell the beginning of a looming recession and eventually a lowering of interest rates. As demand rises for goods, retailers scramble to order more, and in some cases they over-order. In response, manufacturers gear up for those big orders and expect them to keep coming, so they start to overproduce. Retail stores and their distribution warehouses end up flooded with stock that no one wants, no matter how much it's discounted.
Yeah, I mean, there's certain COVID winning categories where retailers may not have, anticipated the right timelines of when the COVID winning categories would unravel. Things like, pyjamas, Ugg boots, gym equipment, home gym equipment were all really popular categories during lockdown. But now we're out and about, some of those categories would be suffering quite significantly.
So is this happening in Australia? Absolutely. And the sector most affected is apparel. A lot of seasonal clothes are now on sale, and lots more.
So for a lot of retailers, it means clearing stock at the expense of margin. So for those retailers that have got warehouses full, it will be important to convert that into real sales, into cash, and clear it as quick as they can.
But it's worse in America, where retailers including Target and Kmart are telling customers not to return unwanted goods, to keep them. If they are returned, they are not resold, but end up as landfill. Michael Burry pointed to a CNN story about this in his tweet.
Products ending up in landfills, customers don't really even think about as part of the purchase process.
Every year, returns produce an estimated 5 billion pounds of waste.
So you get a situation where there's too much inventory eventually, and a massive clearance effect, discounting activity, and we're definitely seeing that in the US. It's really turned quite quickly about 2 months ago and caused a lot of pain for retailers in the US.
Here, the same thing is happening. Warehouses are filling up. Space is at a premium.
We are pretty full. We are extremely full, and it's a good business to be in. Having said that, the growing requests from our customers to store more products. They are rotating certain products, but we still need more space for us to grow.
Call all this the cubby house effect. During the pandemic, home office equipment, gym gear and cubby houses sold in record numbers. Now there are warehouses full of them. Oddly, the same is true for pets. People bought pets for the pandemic. Now when they go on holidays, it's hard to find a boarding kennel. For retailers, this effect is a major challenge. If they get it wrong, it could be terminal. They can try to hang on to the stock and clog up their warehouse. They can sell at whatever discount they can to move the stock. Or they can offload the excess stock to a third party like Grays that can sell the items quickly at whatever price is offered.
So there's a couple of different ways it can be done. Is they would approach, normally there's sort of stock which they might have higher quantities of, and particularly with supply logistics at the minute, there's normally higher quantities in certain SKUs or assets, and we would either sell directly from their locations in a dropship opportunity, or they'd bring it into our logistics warehouses and we would dispatch them from there. And we would sell on behalf of sort of major retailers, other businesses and clearance channels.
Grays, the online auction company, is one of a number of businesses that deals in remaindered and unwanted stock.
Look, it can vary on year to year, but normally it's over 1 million assets, 1 million items a year. And that can be sort of the change here, and what you see in our 11 logistics sites around Australia, there would sort of be anywhere between 15 to 20,000 assets turned over every week.
It sells up to 60,000 cars a year and around 30,000 cases of wine a month.
So we've got a fridge here, white goods. How long would you take to turn this stuff over?
So typically we would get monthly consignments of this sort of stuff in, and we would have it normally sold within sort of 3 to 4 days of being up at auction.
Well, I'm here at Gray's main logistics hub in Sydney, where there are hundreds of thousands of items here for sale, and they move through the products really quickly. Within a week, everything around me will be totally different. But there's so much available here, even the kitchen sink.
Another company that shifts thousands of items per week through its warehouse is B Dynamic Logistics, based at Kemps Creek in Western Sydney.
So we have retailers like Aldi, Costco, and on the other side, Bimex Books Online, and then DoorDash, where we fulfill all the merchandising for food delivery riders and the drivers, as well as the restaurant owners.
BDL is a logistics, warehousing, fulfilment and distribution company which just celebrated its 17th birthday. Chief Executive Mal has noticed increased inventory levels from some of his clients.
That has been the case last 2 to 3 years. The inventory levels are quite high, and the footprint can exceed from a standard contracted footprint double or triple. So we are similar sort of products we are holding 200% or 300% in some cases.
Retail analyst Craig Woolford at MST Marquee says warehouse space is becoming an absolute premium.
Yeah, one of the challenges is the distribution centres are full. Many of them have taken what they call off-site locations, so they'll rent another warehouse to store the extra inventory. The holding cost is probably not the main risk. The real issue is whether they're just caught with too much inventory if demand slows, because in that case they'll end up discounting that inventory and making a lot less money.
And it's the smaller retailers that will suffer the most.
The bigger and more sophisticated some of these retailers are, the better prepared they are to be able to disperse across many of their store networks. The smaller retailers, if they really did bulk up for a Buster 22, they're probably going to feel it a lot worse than the larger chains.
The total size of BDL's facility at Kemps Creek is 26,000 square metres, but with the high levels of customer demand, it needs more storage space. The problem is, with the global supply chain disruptions, the cost of building a new warehouse is getting very expensive.
The challenge is building materials coming to the country for property developers is a challenge, and obviously shortage in building materials in the country at the moment. That has a flow-on effect, not having enough properties available for us to expand to support the retailers. So it's a very, very fine balance, and it's a very tight market right now.
2 weeks ago, the private equity house Blackstone took complete control of Crown Resorts, completing an $8.9 billion takeover. And this week, it exerted that control, announcing management changes that will see Chairman Ziggy Switkowski and Chief Executive Steve McCann leave the business. Former Virgin Australia Chief Executive John Borghetti will become Chairman of Crown's Sydney operations. But it was another Australian investment by Blackstone this week that caught our eye. One of the unheralded success stories of Australia is a company called Expansive, which runs the world's biggest voluntary carbon offset exchanges, among other things. Think about all those companies with net zero carbon emission strategies trying to offset what they do emit. Now, part of the backstory of Expansive is that it tried the list on the ASX earlier this year, but failed to gain sufficient money at the right price. Now, the US-based Blackstone has poured in around $590 million, the same that the company was seeking earlier this year. Expansive's co-founder and chief commercial officer is Ben Stewart, who joins me in the studio now. Ben, many thanks for your time. I just want to go to the business. A lot of people won't know what you do. You've been going for quite a long time, 13 years or so. And this is really something which I guess has been a bit of a struggle along the way. Now it's absolutely right in the middle of where every company needs to be in its aspirations for net zero emissions.
Yeah, absolutely. Look, we started the business in 2009 and, it was a very different time. ESG wasn't even a term back then. And so, trying to get the business up and running and get transactions and flow was really difficult. So, it was a bit of a slog for the first sort of decade, I suppose.
Okay, so what people won't recognise is that your business is as much in America as what it is in Australia. It's a big player in the United States. This is a part of the reason for its success. You've had some key strategic mergers along the way, which have really helped in that ambition and helped to grow the company.
Yeah, absolutely. My fellow co-founder Nathan Rockcliffe and I, took on a smaller round in 2014, enabling us to go over to the US, and he's moved over there and been there ever since, driving the business from the US angle. But the products we trade are truly global. It is a global market, and that's where we need to be boots on the ground where the people are that are looking to drive the business, and so that's why we've sort of found success in being in the US and being able to build the relationships with the infrastructure that helps the market operate. And so,
but it's not just carbon offsets that you trade. So, okay, yes, a business, let's say, for example, Qantas can't help but emit. It's got to if it wants to fly, unless there's new fuel comes along in the future. And so it's got to offset. So it'll come to your exchange to buy, if you like, the credits, and those credits will have a price. And that's the way in which it will offset carbon emissions. And, you could go to a power station, go to all sorts of companies, a supermarket could be doing the same thing.
Yeah, absolutely. Look, Qantas could come directly, or someone could be servicing Qantas and leveraging our platform to access the market on their behalf, to assist them in the process. So, and that's across all parts of the economy. So, yeah, Qantas, power companies, both domestic and internationally, will be making these offerings more and more apparent to their consumers now. So it's something that we're seeing a big growth in, and I think it should continue.
Okay, but on the other side, there's also those that have the credits that they can then come and use your exchange to sell those credits, and you can value those credits. That's been one of the keys of the business, isn't it?
Absolutely. I think one of the things that, we say that it was a hard work during that first decade, but what that really allowed us to do was to go out and really engage with that supply side. In particular, we were able to connect with the registries, which are a key component of the market infrastructure. So not unlike Computershare or Link holds equities, there are registries that hold these carbon offsets so that we know who owns what, where and when. And we set out to create connections with those entities very early on before the market was really taking off. And we're able to get a lot of success and a lot of great relationships. And that's really helped us sort of engage with that supply side of the market.
Okay, so then it's not just, though, carbon offsets that you will trade. There are other markets that you will offer along the way. So just explain some of those.
Yeah, absolutely. We've been in renewable energy in Australia and in the US for quite some time now, offering renewable energy certificates across our platform. We also trade water in the Murray-Darling Basin under our company called H2OX, which has been really successful and is a really interesting market. Has very natural supply and demand drivers. As you can imagine, water's quite cheap at the moment because it's falling out of the sky quite a lot. So those are sorts of things we've had made from products that are in existence now. But we're also moving into new products in the digital fuels space, where we're looking at how can we value ESG and environmental qualities into existing commodities.
Okay, so then just come forward, and this sort of $400 million US that you've raised from Blackstone. In your own heart, being an Aussie and having set this business up in Australia, are you a bit disappointed that it wasn't the Australian equity markets that gave you that capital, that really it was Blackstone?
Look, I mean, we've got deep roots here in Australia. We've got a lot of Australian shareholders that have been very supportive of our business, through a very, difficult time as well as the good times. So, it's always nice to have those Australian roots, but we are still an Australian company. We've got a headquarters here. Look, the money and the capital not coming from an ASX listing, it's just a timing issue. So, I think Blackstone is a fantastic partner for us. I think we'll be able to do a lot of the things we wanted to achieve, utilising them as a fantastic partner and probably increasing our global reach more than we probably would have if we listed on the ASX.
The one thing that Blackstone said this week, which really, again, struck a chord with me, is they believe that you have first mover advantage on a global basis. And that's the reason why they've come and put this significant amount of equity in which would ultimately be equity, which will allow that business to continue to grow. Is that really the key from your point of view as well?
Absolutely, yeah. No, I think that ability for us to leverage their finance and their network to make further acquisitions, the key part of the financing is going to be to purchase those registry assets, which we announced earlier this year through a company called APX. We've already purchased 20%. Mm-hmm. This will allow us to make the further 80% purchase on that and sort of really round out the market infrastructure for this business.
That almost closes it out from what I can see, because then you start to see those who have the credits and you can offer that business, then value them and trade them via the market, which is the way in which I see it. One small thing, I mean, the ASX comes in for all sorts of criticisms for a range of different things. Why is it that you and Nathan innovated in this way and gutsed it out? Why wasn't the ASX the one that was actually leading the global initiative? And why weren't they knocking on your door saying, you've got something that we really need to be the world leader at?
Look, I think the ASX, the Chicago Mercantile Exchange, Intercontinental Exchange, they kind of operate in a different space. What we have done is create a physical market. So we actually transfer the physical assets within the registries when we do a transaction. A lot of those other exchanges really focus around derivatives, so paper-based trading. So physical markets are a little bit harder for them to go into, and I think it just comes down to a cost-benefit sort of analysis for them. So, investing 10 years at very low revenues over that period of time, it kind of doesn't really make sense. And traditionally, the bigger exchanges like the ASX, but probably more so the European and US exchanges, they do a lot of their innovation by acquisitions. So they'll wait till something gets going, they'll see that it looks good, it's proved out, and then they will look to come in and be an ultimate acquirer of those businesses. So that's kind of how they operate in this space.
Great story, really interesting, and great to get you in on the program today. Many thanks for your time.
Thanks, Ross.
Yeah, it's a great story. Coming up after the break, US inflation is firmly in focus in the coming week, and as are interest rates. Adam Crichton, direct from Washington, DC, up next. Thanks for being with us here on Business Weekend. Now, this week, all eyes around the world will be on the US and its economy. The inflation rate for June will be released on Wednesday, its time, and it's broadly expected to come in just under 10%, 9.5%, somewhere around about there. Now, the issue of inflation, as we've discussed, is whether the relentless increase in rates will trigger a recession or whether the Federal Reserve can skirt around it. So let's go to Washington correspondent for The Australian and also the Sky News contributor, Adam Crichton. Adam, I'm going to start with just a pretty obvious one for you. As you walk around Washington right now, does it feel like there's a recession?
Look, I wouldn't say so. I mean, my view is that, as long as the unemployment rate is very low, and it is very low here, 50-year low, 3.6%, and probably even lower in the Washington, D.C. area because of all the government work, that it's not a real recession, I think, until you have a high unemployment rate. But certainly, more and more investors, more and more analysts are saying that the US is already in one technically, and that's based on the second quarter growth figures, which we don't have yet. But certainly, if you look at the Atlanta Fed, which does a week-by-week forecast of GDP, the economy is already shrinking in the second quarter by about 1%. I think, 2.1% is the latest contraction forecast for the second quarter. So if that's true, then according to the rule of thumb, 2 negative quarters, then yes, the US is already in recession.
Okay, so it was interesting because this week the US the White House spokesperson was asked exactly that question. So here's the response that came.
Do we believe we're in recession? No. That's my answer to you on that. So there is a nonpartisan data that came out recently, the National Bureau of Economic Research, which I'm sure you know very well, Ed. It determines and defines recession.
Yes, Corinne Jean-Pierre, I understand she's on her way to a different job at the moment as well. But I just want to go to this point because, you know, the Bank of England talked about the narrow path it's on to try and sort of have the soft landing and not fall into recession. Its inflation's now on the way to 11% and beyond. In the United States, you know, sort of getting out towards that 10% mark. Again, that sort of narrow path, not to tip your economy into a deep recession, that's what they're trying to avoid.
Yes, look, certainly that's true. I mean, the White House spokesman there, she is right. I mean, in the US, the dates of recession are actually determined by this independent body known as the National Bureau of Economic Research. They decide these things. It's not the rule of thumb that we use in Australia, that they use in Europe. But nevertheless, look, there is a serious risk of much higher unemployment, I would say, in the third quarter of this year when those interest rates keep rising. I mean, it's certainly inevitable, at least based on history, that if you have much higher interest rates, you will get a dramatic slowdown in the economy and an increase in the unemployment rate. And if that happens, I think, combined with slowing consumption growth, which recently has been very patchy, very weak in the US, you will get a recession. And not just a technical one, not just one that the economists talk about, but the ones that ordinary Americans certainly feel.
Okay, then there's the other aspect of this, and that is the ability for government to deal with the recession. Now, sure, the United States could reverse policies, cut interest rates, could start to print more money if they really wanted to, and certainly that's open to what happens in Europe and Australia as well. But they're not in necessarily significant better shape because their balance sheets haven't recovered from the COVID recession.
Yeah, look, that's right. I mean, my view is that there won't be much further stimulus and so forth because the US government is one of the most indebted in the world, has more than 100% of GDP, I think, is public sector debt. And the interest rates are rising. The 10-year bond yield is now 3%, so that's going to make it far more expensive to roll over that debt, which is going to put huge pressure on US government spending and US budgets more generally. So I don't think that they have the options that they may have had, say, in 2008, 2009, to spew out all of that spending, or indeed as they did at the start of the coronavirus. So I think that's the fear, I think, from governments, that if there is a recession, that they're simply not going to be able to borrow and spend as they did without making their budgetary situation even worse.
Adam, as always, we appreciate your input on the program, and we'll talk to you in the next couple of weeks.
Thanks, Ross.
Yeah, Adam Crichton there, finishing up our program for today. That's it for the Business Weekend this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday. And don't forget, you can keep up to date with all the latest business and finance news with our daily program, Business Now, 4:30 and 10:30 p.m. Eastern Time. And also, you can catch the program via our website at skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.